out of Los Angeles, but in the meantime, some headlines in tech today. Joining us this morning from San Francisco is Jason Calacanis, angel investor and founder of Inside.com. Jason, welcome back. Good to see you.
Good to be here.
I got a lot to talk about. Apple's first up, lower this morning. Shares are down more than 17% from the high since reaching that high back in April. Now it's Dialog Semi cutting their revenue outlook, and other chip makers like Skyworks and Avago are lower in sympathy. Of course, it comes the day after Morgan Stanley cut its iPhone outlook as well. Jason, we always like to sort of needle analysts who do channel checks, but more and more people are asking whether these are actually onto something.
Yeah, I mean, listen, the iPhone sales have been tremendous, and it's 60 to 70% of their revenue earnings. And, you know, the watch has done fairly well. They think they're going to do 20 million of those in the first year. So the question is, are people going to keep upgrading their phones, and are they going to chip away at the Android base? And I think that's actually where I'm optimistic about it. There's talk of a smaller iPhone in this next generation, a 7C, if you will, which would be very similar to the iPhone 5's profile in terms of size, 4 inches, and fit very nicely in your hand. I'm very bullish on that if they could capture some of the low-end market and people who want a smaller phone that's maybe a little bit more competitive in terms of price. So I'm bullish on Apple. I think people underestimate what a delightful product the iPhone is and people's propensity to upgrade them early. People love to have the latest iPhone. And if you look at the investment they're making in screens and, you know, in new features and in the operating system, Apple's moving at a very tremendous pace, you know, very fast pace in terms of adding features to the iPhone, including, you know, upgrading the cameras and pushing down on the device to get a new experience. So I'm actually bullish on it, and Apple has $200 billion in cash and is investing it very heavily in new products, new screens, new chips. So I'm very bullish on it.
It's one thing to be bullish on Apple from a product perspective, even a platform perspective, but I think it's interesting as a stock, we've seen the company get actually increasingly reliant on the iPhone, particularly in the profit arena as the years have gone by, even if as it's tried to diversify out with the iPad. Also, that iPhone cycle has gotten more and more concentrated in the holiday quarter. It seems possible to me that in the next year, you see them gain on average selling prices of iPhones as they get more upgrades more quickly, as people maybe trade up to higher capacity versions, but that doesn't necessarily mean that they're going to move a lot more units. Isn't that the issue?
Yeah, I mean, the issue is, have they reached their natural audience for this, and is it a high-end product, or can it keep going down market? I believe it will keep going down market, and I think they're going to keep coming up with compelling ways to trade in your existing product. Just as an anecdote, moving from the 6 to the 6S was a very delightful experience. You can go to the store now, and Apple will buy your phone back from you and resell it. You don't have to go to some third party. Of course, we're all waiting to see if another category, like the watch, or the Apple TV, which is really a gaming device in my mind. I have the new device, and it feels like a gaming device more than just an Apple TV device. And of course, investing in cars and perhaps a television set. Can any of these become material and keep the percentage of revenue coming from the iPhone from becoming 80 or 90% of their...
Right, exactly.
Yeah, I mean, it feels like it could go that way, right? And it's a testament to exactly how powerful smartphones are in our lives.
Very true. They are a phone company through and through, at least today. Meanwhile, Jason, Howard Stern sticking with SiriusXM, announcing he signed another 5-year deal, some of his content for a 12-year deal, only a day before his previous contract was set to expire. On the website, he said, quote, "This deal enables us now to move really into the future, not only to continue to bring you radio for the next 5 years, but an app will be developing that will now include video streaming of the show." SiriusXM is trading higher this morning. For a guy who made the leap from terrestrial pretty early on, this is another indication of where distribution's headed, right?
Yeah, absolutely. I think what Sirius has done really well in terms of keeping Howard is improving their app. Their app has gotten much, much better, 10x better in the last year. Howard's probably responsible for 10% or more of the subscriber base of SiriusXM. So 3 or 4 million people paying $120 a year or something in that range. Howard is making $80 million, so he's probably getting a third of the money coming in for people who are directly subscribing because of his show. And his show has really become much more mature. What people perceived as the Howard Stern Show 10, 20 years ago you know, with a lot of salacious and sexy stuff, it's become a very, you know, more Charlie Rose type experience with a lot of high-end guests. So I thought actually Spotify or Apple might actually make a run at the more mature Howard Stern at 60 years old. He chose to stay there, and obviously with 4G and LTE, streaming the video to the phone is something that Sirius will become capable of. And people don't want to, you know, have SiriusXM in their dashboard anymore because you can't time shift it. The big trend is going to be people to have 4G and LTE in their dashboard or connect to their dashboard, obviously, with their smartphone so that you can do it on demand. And they've made great strides there where you now can download shows on SiriusXM offline. So if you're on an airplane or you don't have a great connection, you're going into a subway, you could download yesterday's Howard Stern show and listen to it offline. So Sirius understands they're an app company now. They're really in competition with Spotify, and keeping Howard was, you know, a brilliant and necessary thing for them to do.
Yeah, but I'm wondering, from a big picture standpoint, Jason, we saw Sirius shares up as much as 4% earlier in the market day. To have so much riding on one key man or a few key people in this day and age with all of the oversupply of content, is that too big of a risk for a single company? Do you need to spread it out a little bit more?
Yeah, I think they need to, you know, sort of become more Netflix and HBO-like in their ability to develop more talent and take more risk. Obviously, they have Howard Stern, but the next biggest, you know, draw on there, it's a steep drop-off. And so, you know, the Oprah and Martha Stewart channels and those type of things, they never really panned out. And it would be really good if they could develop second, third, fourth celebrities and stars who could drive 1 million or 2 million subscribers. I think they have to take a page out of HBO's book, Netflix's book, and really, you know, try to have their own house of cards, try to have their own, you know, Last Week Tonight kind of shows. And if they're going to do video with Howard, maybe this is a sign that Sirius is looking to become more like HBO. If you've got 29 million subscribers, wow, what an amazing thing to do. Maybe they should invest in doing some video shows. And you know what? If you look at podcasting, it's become quite a revolution in terms of the number of podcasts out there that are making $1 to $10 million a year. We never thought that was possible 10 years ago. But there is some serious talent out there doing video shows on the iTunes platform, on podcasting platforms. They should really be just stealing the top 10 podcasters and paying them a real wage to move to Sirius and their app.
Finally, Jason, this another crack in the private tech market. Gilt Group's in talks to sell itself to Hudson's Bay for $250 million. That's according to the Journal. It's after the company raised money at a reportedly $1 billion valuation. They had to delay the plans for the IPO. Same day that One Kings Lane is laying off a quarter of its staff. That's according to Recode. 18 months after earlier cuts, and that company was valued at $1 billion in early 14. What do you think's going on there? More of the same?
Yeah, I mean, listen, we all know that the private market got a little ahead of itself in some cases, and now we're going to see companies say, hey, maybe I'm not going to be able to raise that next round on the terms I did last time. So in One Kings Lane, they're probably saying, let's get this company, you know, super profitable and tighten up ship. And in Gilt Group's case, oh my God, they only sold the company, or they're only going to sell the company for $250 million. I mean, it's still a tremendous success. And as we've discussed many times on the program, the people who invested in those later rounds have protection. They have downside protection. So I don't think you're going to hear any of those late-stage investors complain, because they're going to get their money back and a little bit extra, and they would have had the optionality of that company becoming worth a couple billion.
Isn't the story that this revolution in mobile retail never really happened? I mean, you look at Fab. I mean, Etsy is hanging in there, but has not blown the doors off. When I look at, you know, I bought stuff from Gilt, bought stuff from My Habit, which Amazon owns, by the way. When I look at who's really making advances in mobile retail, Amazon, and to some extent eBay, far and away ahead of the rest. This isn't one of those stories where the next wave of companies came in and disrupted the first wave, the way Facebook came in the social era and disrupted Google and others. I mean, isn't that the real story?
100% correct. Yeah, it's 100% correct. Listen, if you're unlucky enough to get into e-commerce and have to deal with Jeff Bezos as a competitor, you know, he's the 80,000-pound gorilla in your market. Whatever innovations you do, he's going to do better, and he's going to do them more efficiently with tens of millions of Prime subscribers. So, yeah, it's an incredibly difficult field to get into, and I think the natural audience for flash sales was hit long ago, and it might have been something like Groupon that did particularly well in a recessionary environment where people were looking for bargains. But as the economy comes back and people are doing tremendous, you know, and you have people making double, triple the minimum wage in these medium wage jobs that are on demand. People have more money to spend, and you know what? They're not driven by discounts. They're not trying to get a $10 yoga lesson. They don't mind paying $25 for the yoga lesson.
For me, the problem with guilt, and to some extent, my habit was they stopped with the really high-end brands at a discount. They started selling kind of like generic luxury, and it's like, yeah, I can get that anywhere. I don't even need to check you out anymore. Well,
when's the last time any of us have gone to like the outlet mall, right? Like, when times are good, people don't go to the outlet mall.
It's a big country, Jason, but I think we get your point, at least at this desk. Good to see you again. We'll see you next time. Jason Calacanis joining us today.